Imagine compounding wealth on money the Internal Revenue Service never touched. Section 1031 allows investors to defer capital gains tax legally. This happens when exchanging one investment property for another. This mechanism is strictly tax deferral, not tax avoidance. The realized gain is carried over into the basis of the replacement property. This maintains the tax liability until a later sale occurs. This provision applies only to real property held for investment use. It also covers property used productively in a trade or business. The primary benefit is continuous compounding on pre-tax dollars. This significantly accelerates portfolio growth over time. The transaction must be a direct exchange of property. It cannot be a sale followed by a separate purchase. This rule is fundamental to the entire process. The term like kind refers to the nature or character of the property. It does not relate to the grade or quality of the asset. For example, raw land qualifies for exchange with an apartment building. A single-family rental can be exchanged for commercial office space. All properties involved must be located within the United States. Foreign real estate absolutely does not qualify for a 1031 exchange. The Tax Cuts and Jobs Act of 2017 eliminated personal property exchanges. This means equipment or artwork no longer qualify. The property must be held for investment intent. This intent must exist both before and after the exchange transaction. This requirement prevents using 1031 for quick flips or personal use assets. The investment intent is crucial for Internal Revenue Service compliance. The exchange process is governed by two strict statutory deadlines. These deadlines begin running from the closing date of the relinquished property. The investor has 45 calendar days to identify potential replacement properties. This period is known as the identification period. The identification must be unambiguous and in writing. It must be signed by the taxpayer. The identification must be delivered to the qualified intermediary. The investor must acquire the replacement property within 180 calendar days. This second period is called the exchange period. These deadlines are absolute and cannot be extended under any circumstances. This remains true even if the 180th day falls on a weekend or a legal holiday. Missing either deadline immediately disqualifies the entire exchange. Strict adherence to this timeline is mandatory for deferral. A qualified intermediary is legally required to facilitate a deferred exchange. The qualified intermediary is also commonly known as an accommodator. The qualified intermediary holds the proceeds from the sale of the relinquished property in escrow. The investor cannot have actual or constructive receipt of the sale proceeds. This prohibition applies at any point during the exchange period. If the investor touches the funds, the transaction is immediately disqualified. The full capital gains tax becomes immediately due. The qualified intermediary handles all necessary documentation for the exchange. This includes the assignment of the purchase and sale agreements. The qualified intermediary ensures strict compliance with all exchange rules. Using a reputable qualified intermediary is essential for a successful tax deferral. Achieving a complete deferral requires meeting two financial requirements. The replacement property must be equal to or greater in value. This comparison is made against the net sales price of the relinquished property. Second, the investor must replace any debt on the relinquished property. The new debt must be equal to or greater than the old debt. If the investor takes on less debt, the difference is considered taxable. This difference is specifically called mortgage boot. The investor must use all net proceeds from the sale. These proceeds must be applied toward acquiring the replacement property. Failing to reinvest all proceeds results in taxable cash boot. Meeting both the value and debt requirements ensures full tax deferral. Boot is any non-like-kind property received by the investor during the exchange. Boot is immediately taxable as capital gain. Common examples include cash received directly by the investor. Debt relief, known as mortgage boot, is also considered boot. Non-real estate assets included in the transaction also count as boot. If an investor receives $50,000 in cash boot, only that amount is taxed. The remainder of the realized gain remains deferred. Boot received reduces the tax basis of the replacement property. The investor is taxed on the lesser of two amounts. These amounts are the realized gain or the total amount of boot received. Understanding boot is key to minimizing immediate tax liability. The capital gains tax deferral achieved through 1031 exchanges can become permanent. This occurs upon the investor's death. When the investor passes away, the property receives a stepped-up basis. The new basis equals the fair market value at the date of death. The deferred capital gains liability accumulated over decades is completely eliminated. This elimination benefits the investor's heirs directly. This mechanism allows investors to continuously roll over gains. They can execute multiple 1031 exchanges throughout their lifetime. This effectively achieves a tax-free wealth transfer to the next generation. This basis step-up is the key legal provision. It allows investors to defer capital gains tax forever. This strategy maximizes generational wealth transfer. A primary residence does not qualify for a 1031 exchange. It is not considered property held for investment use. However, a vacation home may qualify if specific rules are met. The Internal Revenue Service provides safe harbor rules in Revenue Procedure 2008-16. The property must be rented out for at least 14 days per year. The owner's personal use must not exceed the greater of two limits. The first limit is 14 days. The second limit is 10% of the total days rented during the year. Exceeding these personal usage tests disqualifies the property. Investors must rigorously document all rental activity. This documentation proves the required investment intent to the Internal Revenue Service.
The 1031 exchange is frequently targeted by legislative proposals. These proposals aim to increase federal tax revenue significantly. Investors must constantly monitor potential changes to the law. Recent proposals included limiting the amount of gain deferred annually. State taxes also apply independently of federal rules. Some states require taxpayers to pay state capital gains tax immediately. This occurs even if the federal exchange is successful. Pennsylvania is one example of such a state requirement. Investors must ensure the replacement property is acquired with investment intent. This intent is typically demonstrated by holding periods exceeding 2 years. A short holding period invites intense Internal Revenue Service scrutiny. Compliance requires careful planning and documentation.